This is the business of Africa. If it's about Africa, then it's our business, bringing big and small business issues right to your doorstep. So no sooner had we wrapped our heads around executive orders that shook world trade policies, the defunding of multilateral institutions, right down to the disruption brought about the deployment and adoption of AI, we then had to contend with the war that has caused major disruptions to the oil, gas and fertilizer markets. We review how the world economy has fared in the first half of this year as we look forward to 2027 already. Simon Brown is founder of Just One Lap, and he joins us to do exactly that. Mr. Brown, always a pleasure. Looking at the first 6 months of this year, what picture is emerging for you at least?
Dudu, thanks for the opportunity. I mean, surprisingly, I think one of resilience. You know, the first 2 months to the end of February, markets were looking good, expectations of rate cuts coming, inflation lower, everything looking rosy. And then, of course, as you mentioned, the war started, the US attacked Iran. That sent, urea prices, fertilizer almost doubling in price. That sent oil almost doubling in price. And yet here we are, almost 6 months later. And I mean, to be clear, we're not in a position we had hoped to be, which from the beginning of the year. But I think we're not in the horror that I think many would have thought of, which is why I think more than anything, it is perhaps that resilience.
You speak of resilience, and the IMF in their World Economic Outlook update, they note that on the back of these developments, which is global financial conditions, which is AI and the oil market, which we'll get into, global growth in the first quarter of 2026 turned out to be stronger than expected, slowing from 3.8% in the fourth quarter of 25 to 3% on a quarter-over-quarter annualized basis instead of the 2.7% they had forecast for April. What do we put this down to?
I think there are a couple of things. And I want to stress, resilience, yes, but that doesn't mean it isn't a tough road there, particularly for consumers. And consumers the world over have seen, energy costs, transport costs, fuel costs are rising. But I think what really struck us, we essentially lost 10% of the world's oil supply going through the Straits of Hormuz, which then just disappeared overnight. And oil got to, looking at Brent, got to about $120 towards the sort of mid to late March. A lot of expectation was that oil would get much higher, closer to 150. There were some folks out there predicting even $250. It just didn't happen. And I think two things drove it. One was, in fact, a couple, but the one was there was some demand destruction. In other words, people just traveled less. We saw it in some markets like Philippines, where, they said to folks, only go into the office every second day. We saw airlines cutting back, and not because they couldn't charge the surcharge, which many did, but just cutting back, just reducing demand. We saw strategic reserves being released, and certainly that played a big part. And I think China, perhaps a bigger part than we thought. We don't know quite what the story is with China and their reserves, and we can go down that rabbit hole in a moment. But the strategic reserves certainly helped a huge amount. And then I think just more broadly, our dependency on oil in the immediate. It is important to be very clear. We run on oil as a global economy, but perhaps not quite as much. In fact, certainly not as much as we did, for example, back in the 70s when we had the oil crisis. We see that oil is important, but sort of per unit of GDP, we use less oil than we were 10, 20, 30, 50 years ago during previous oil crises.
So it's incredible how we can adapt. I'd like for us to go down that rabbit hole in terms of China, because you read the literature and it suggests that they could have very well single-handedly saved the world economy because they didn't order as much. In 2025, they were the world's largest consumer, right? And now we're seeing them relying on their reserves. How should we understand that story?
You're totally right. Last year, China was the big user, and this year they took, post the invasion, they basically reduced their demand by about 3 million barrels when we were short around 10 million. So that is absolutely significant. What we don't know a lot about China. Many countries publish details around strategic reserves and how much they've got, etc. China does not. Some of their reserves we can physically, literally see via satellite because it's in open tankers, but a lot of it is underground, and we don't know what it is. So the first sense is that China probably had a lot more oil reserves than the world had thought, which meant of the approximately, say, 100 million barrels a day that the world is consuming, some of that consumption was actually just going to strategic reserves. And that then got inversed, in which instead of filling up reserves were actually emptying down. And it would seem that China had a lot more than the market had anticipated. And they were able to manage internally and therefore import less. There is another point as well. They've got a lot of which they call them teapot refineries. These are sort of small, I almost want to say mom and pop, but not mom and pop really in the true sense, but smaller refineries that use sort of the less popular crude, most notably heavy sour, which is Venezuela. And we know what happened in Venezuela in the first week when the president got they were kidnapped back to the US. Their oil started flowing, T's and C's in terms of infrastructure. But I think certainly, I think China's played a significant role in lessening the impact of the oil crisis on the global economy.
You speak of consumption, right, and what the consumer is facing generally, even though the effects of all of this are uneven. In many economies, like you said, the consumers are feeling the pinch. And so how should we understand the fact that prices have been subdued, especially where oil is concerned? The fears have not materialized yet. Maybe we should say that. And then you see that inflation, many monetary policy decisions are pointing to, increasing interest rates. How should we understand those two dynamics?
I mean, it is going to put pressure on the consumer's household budget. I mean, they are, in the immediate, they are paying more for transportation of whatever type it might be. They are paying more for debt because of interest rate increases that we've seen in many, many markets. The US, not as of yet, but the expectation was that by now they would have had a rate cut, and that hasn't come to pass either. And of course, we've got a bunch more meetings around central banks over the next couple of weeks that will give us better indication. But it does put the consumer on the back foot, and some of it is immediate. The petrol price increases in South Africa were first week of April. The government cushioned some of that with reduction in levies. Some markets, such as the US, the price move is almost instantaneous. Some of the moves going to come later. You mentioned fertilizer and urea at the top of the show. Urea doubling from 350 to 700. And to be clear, it's now back at 420, so it's come a long way down. That isn't yet so much showing up in the price of food, because that food is being planted, it's being fertilized, there's diesel being used in the process. That's food that's going to get to our table sort of towards the end of winter as we go into spring and summer, and then we're going to start to see some of those increases. So whilst our fuel bills come down, they're still well above invasion levels, and there's still some more pain coming, potentially rate increases, potentially higher food costs down the line as well.
Add to that, El Nino, it is not looking good. This report also speaks of strong corporate earnings and a resilient global economy that have helped cushion the financial system. How should we understand, because we've had stellar performances from many companies rather on the S&P 500. So how do we understand that, right? These record earnings and what we are seeing, especially in the world economy.
You're spot on. We are seeing absolute record earnings, and the earnings season in the US, which kicked off, has shown, particularly amongst the banks, just insane strength in those earnings. I think we need to, if we go back to the pandemic, one of the there were all sorts of challenges in terms of supply chains and logistics, but one of the things that we did see in the pandemic was margin expansion. In other words, companies such as Pepsi, for example, and others in the food space and the consumer space were sort of expanding on their margins, using that opportunity of higher inflation to inflation pushes the price up, say 3%, add an extra 0.5% to the margin, and the consumer will hardly notice. There'd been expectation, and this goes back to beginning of last year, that margin expansion was probably over, and if anything, we might start to see some contraction of the margins, which would put pressure on earnings. We just haven't seen that. Margins have remained if we look at the S&P 500, consumer-facing stocks, margins are as good as they have ever been in those sectors. So they've managed to maintain the margins, and the consumer came into the beginning of the year in a fairly well-off space. Savings were not too bad. As I said, inflation was coming back. The US has been above their target now for close on 5 years. but it was still sub 3%. Rates had been coming down, or at least paused, and so the consumer was looking in a better space, was able to spend, and retailers and listed companies had maintained those margins, which has led us to absolutely record profits that we've seen and continue to see as we get the second quarter earnings coming through.
How should we understand the relationship between, or is there a relationship between the markets and the economy? I ask that maybe in terms of sub-Saharan Africa. So this outlook points to GDP growth in terms of South Africa. You've got 0.5% in 2024. In 2025, it was 1.1%. In 2026, it's projected 1.1%, and 2027, 1.3%. We're barely moving the needle, and I think the effects are felt on the ground more so when you speak of what the consumer is facing, when you speak of unemployment in this country. Yeah. How do we understand the two? Is there a relationship?
There is primarily not a relationship.
Okay.
And I mean, the numbers that you're quoting there indeed show just how tough it is being a consumer in South Africa. But a number of the large companies on our market, I mean, some are just absolutely efficiency machines, and I'm thinking of Shoprite. Others, such as Standard Bank, are earning a fair chunk of revenue these days across the rest of the African continent, and others, such as Richmond and the like, do very little local business. Mm-hmm. Therefore, not really a reflection of what's happening on the sort of main street of South Africa. So that relationship between the two, fairly tenuous. We came into the year with our market at record highs. We'd had 14 green months in a row, which we had never seen before in our market. That to the end of February. And whilst the consumer was perhaps in a better place than they'd been in some time, it was still tough being a consumer in South Africa. There was, we weren't sharing the love that the stock market was getting by any stretch.
GDP. Please talk to us about GDP. As we understand, it is the primary economic indicator, and it measures the overall health of the economy in South Africa. 1.1%. We look at Nigeria in 2025, 4%. Egypt, 2025, 4%. We're not growing. Because this question keeps being asked, how do we stimulate the economy in South Africa, And we look at our peers on the continent. I mean, it's a far cry. How do we understand GDP overall, and why are we not performing as a country?
So, I mean, GDP in of itself is essentially the size of your economy. What is the value of all of the productive assets within an economy? And the metric that I like is a GDP per capita. In other words, per individual. Mm-hmm. And that's less about the absolute number. That's more about what's happened to that number. And if we look at South Africa, you're quoting GDP of 0.5, of 1, 1.1, maybe 1.3. Our population growth every year is probably about 1.3, maybe 1.5%, which means that South Africans on aggregate actually get poorer every single year, as opposed to folks in, you mentioned Nigeria, Kenya, Egypt, etc., who actually are getting richer. And these are stats, and of course, it's applicable to everyone. But we just can't get our. There's a couple. One is logistics. But logistics is also a weird one because, to be clear, Nigeria has logistical challenges at the same time, in terms of ports, in terms of rail, the problems that we have. Maybe not always as severe, but certainly they absolutely have it. I think part of it perhaps is also just inefficiencies in our economy, which is perhaps a polite way of saying that there is levels of corruption that are almost endemic and deeply sort of built into the process. And here I'm thinking of the stories around for example, the construction mafia. And just sort of, add zero utility to the industry, but add a significant cost to the industry. And I think maybe that's more than anything where we've been sort of losing out on, where we can't get our efficiency levels going, we can't get the economy going, and we've got a huge burden of unemployment and SARS grants, and that just sort of that's not necessarily dragging the economy, but it would be, if we could get it going, it would be the benefit to the economy. And at this point in time, we're just not getting any sort of growth. We had hoped this year for 1.8%. That has been revised down post the invasion of Iran and the fuel price increases and rate increases, etc.
And therein lies the tragedy. Looking ahead into the year as we fetching 2027, it's gone by so fast. What can we expect? Because sub-Saharan Africa, I'm not sure how to even characterize this, but we are missing in that value chain of artificial intelligence, where we're more consuming rather than, playing a substantial role in it. So where do you see 2026 going as we enter 2027, not just for the world, but for us here at home as well?
So just to quickly touch on the AI story. I mean, you're right. As a continent, I think there are bits happening. There are research projects. We've got an AI called Protea, which was launched a couple of weeks ago. That looks significantly impressive in terms of its size rather than perhaps its compute power. So we are doing bits, but we're doing it very, very small. And yes, there's some of the PGMs, platinum group metals we mine, are used in hard drives and the like, the SSDs, but again, very, very small. I think we are sort of falling behind. Although, to be clear, the AI race at this point in time really is the US and China. It reminds me of the space race of sort of the 50s and 60s, which was US and then the USSR, Russia. There are other bits happening, but even Europe, I think, is getting left behind to a fair degree. They've got Mistral. Mistral's a bit of a B grade sort of a large language model. In terms of economics, I think that the fuel shocks that we had in the first half of the year, I know that Brent has been running again. I know that the conflict has flared up again in Iran. I think we will see a move towards peace. It's just not going to be smooth. It's not going to be linear. It's going to be lumpy. There's going to be the flare up in conflicts as you've been seeing, and that will be bad for oil prices. We've also had Ukrainian drones attacking Russian refinery. That's taken a lot of Russian supply out of the market, which has seen oil prices heading higher. So I don't think we're out of the woods in terms of energy costs, but I do think the worst is behind us. But I think the consumer is still going to have a tough year. We might find that the pump is better for us, but we're going to find, we might get more interest rate cuts, increases rather locally. Inflation is probably going to be sticky. That food pricing, which I spoke about earlier, is going to start coming through. I think it's going to be a tougher second half of the year than we had anticipated, although perhaps not as bad on the wallet as sort of April and May were with the record petrol and diesel prices we had at that point in time.
Just in terms of the interest rate increases, just looking at what happened and the monetary policy response of 2022, and you look at what is happening now, you've got some sectors of the population that think, well, perhaps it might be a mistake to go on a hiking cycle. I'd like to get your thoughts on that.
Yeah, look, I mean, far be it from me to critique the MPC. I know why they raised rates, and what they worried about is inflation expectations, and they're worried about sort of second tier impacts on inflation. And I hear them, and they're absolutely spot on. I just think this is not a supply or demand rather inflation shock. This is a supply shock, and that's beyond the consumers that we do see. But it's also about credibility. It's also about the Reserve Bank saying, well, hang on a second, our target is now 3%. We've got a 1% either way, which means technically upper range is 4%. We're at 4.5. We have to be seen to be doing something. Yeah. Otherwise, what is our job? What is our mandate? What are we doing here? Do we get another increase? I don't think we need one. I think it's going to be touch and go. The last vote was 4-2, 2 voting against, 4 voting in favor. So it is close, but we've got to convince 2 members to change their mind and make it 4-2 in favor of no change. And I think it's going to be a touch and go. I do think if we get a 3-3 vote, I think the governor will vote for the increase. So it's going to be a tough call. I understand all the logic behind it, but it is punishing consumers for something which is just 100% not the consumer's fault. This is beyond a demand driven, and us going and spending too much in a frenzy. We don't have the wallet to do that at this point in time.
Simon Brown is founder of Just One Lap. Thank you very much for tuning in to the Business of Africa podcast, where we bring big and small business issues right to your doorstep. You'll hear from us again in the next fortnight, God willing. Bahaichu. Bula.